All right, welcome back, everyone. You have to decide if you're glad to see me or you're wishing that you, like I was this morning as Dave was talking about the eclipse coming, wondering if Bob was in fact now going to sing either Ring of Fire or Total Eclipse of the Heart. We were unable to convince him to do so, so you're stuck with me and my bad jokes. It's a great pleasure to invite Morgan Bazilian, who leads the Payne Institute at the Colorado School of Mines, up to host our next panel. And I'll let Morgan introduce the panelists, but we are just going to pivot now to financial and insurance industry needs for credible emissions information, keeping in mind this kind of theme that there are lots of different questions we'll want to answer with data, lots of different stakeholders, lots of different endpoints. And so, Morgan, over to you.
Well, first, thanks to Aaron and Bob and Arvind and Dave and the team and Simon for putting on what I think is and Andy, apologies, a terrific event that we're all very much enjoying. And it's my honor to be here and to chair a session for the next 55 minutes or so that's a little bit different than most of the other sessions to date. And this one we're focused on finance and insurance as opposed to mathematics and regulations. So we have four terrific panelists. Oh, and we have Ben Ratner on the screen, as you can see, and three panelists with me. I'm going to just briefly introduce them and ask them to make opening sort of salvo remarks for a few minutes, and then we'll move into a discussion and questions and answers. A couple things from my side. I joined the School of Mines about 4 years ago from the World Bank, and so I have some idea of finance stuff. The World Bank is not a real bank, despite what they say. Most of my friends, when I took the job there, asked me if I could get them a free toaster with an account. So that's a tiny bit about me. The second thing I was going to say, building on my colleague from the Colorado Department of Public Health and Environment, is that Colorado is indeed better than Texas. I've had, I think, Professor Hammerling in the row here is probably the best mathematician in the room, and she has done the calculations with her students for me. To the graduate students in the room, you've had a lot of job offers already, which I think is terrific. There is a workforce development need in this area. I would offer to you that this panel and the companies that they represent probably pay better than the other ones. We're talking to several publicly traded companies and huge financial organizations. ESG is a politically loaded set of words, an acronym in the United States, and I think we'll maybe pull out some of that without going too deep into the politics of it. The last thing I'll say about I direct an institute at the Colorado School of Mines called the Payne Institute. We have all kinds of ongoing work, including in methane emissions. But one of the things that we also do, which was referenced, I think, by Ben and others, is that we provide the world's best data on flaring. And so most of the big energy companies get that data, as well as the World Bank and various other international organizations. So I just wanted to mention that to you, since a lot of people don't know that. In any case, let's start. Ben, we have you online. We understand that JP Morgan Chase IT does not like Teams very much, but we're thrilled that you joined us. Ben is the Executive Director of Sustainability at JP Morgan Chase. And Ben, the floor is yours for a few opening remarks as you like.
Very good. Well, thank you, Morgan, and thanks to colleagues at the University of Texas for having me today. I very much wish that I could have been there in person. I've had the privilege to work with a number of you, I think, in the past. And you know why EDF cares about methane emissions, my old organization, but you may be wondering why JP Morgan does. So I think for these brief opening reflections, Morgan, I'll share a couple of thoughts about that. Look, we see the methane emission reduction opportunity in the oil and gas sector as a potential triple win for climate, for energy security, and for the bottom line. In recent times, we've been increasingly sharing the message broadly that we need to pursue both accelerated climate action and also energy security, reliability, and affordability. And one of the immediate action steps that we see is exactly this one, that this good conference is focusing on around methane emissions for reasons that you all as leading experts, I think, very well understand. And that is why our CEO has said that minimizing methane emissions and virtually eliminating wasteful natural gas flaring, Morgan, you mentioned a moment ago, that those are good goals. And we've pointed out that this will take more financing, not less, for the industry. The company, JP Morgan, is committed to working with our business partners, our clients in traditional sectors of the economy, including oil and gas, through the transition and pursuing carbon intensity reductions as an important part of that in a supportive way. And this is one of them. Thanks.
Thanks very much to Ben Ratner. I'm going to move just down the table from me. Next to me is Matt McMullen. He's Executive Vice President, Global Climate Practice Leader and Energy Industry Practice Leader at Chubb, which is an insurance company that includes casualty insurance. I've just been practicing saying the word. Matt.
Thank you, Morgan. I'll provide a little more detail on what we do beyond casualty as well. Matt McMullen, thank you very much to the MDEL team for having me. Really appreciate being here. I lead our energy practice for North America and our newly created Climate Plus business, which we launched in the beginning of the year. For those of you that don't know Chubb, we're the largest publicly traded property and casualty insurer globally. We have operations in 54 countries, and we ability to transact business in over 200. One of the kind of hallmarks of our structure and success has been specialization of underwriting. So we create industry practices where we have teams of underwriters and teams of risk engineers that's specialize in certain disciplines, right? So we've had an energy practice since sometime in the 80s, so it's been around for a very long time. We launched our new Climate Plus initiative in the beginning of this year, and that really is focused in three main areas. It's focused in renewable energy, in renewable and alternative fuels, and climate technologies, right? And climate technology, super high level, all of the technologies, manufacturing, and processes that go behind reducing emissions in the economy today. So we launched that as a global practice, kind of using our traditional framework of specialized underwriting and combining that with risk engineering to promote this business and to enable progress with respects to climate change. And you may wonder why that's important to our industry. We rely heavily in insurance on historical data, right? Historical trends, actuarial models, and that's what traditionally guides us in our deployment of capacity within the industry and how we price risk and what type of limits we can put out. If you think about it, property as opposed to casualty insurance, property insurance is what we refer to as short tail risk, right? When a hurricane hits, when a wildfire hits, you're having a loss and you know it pretty quickly, right? Casualty insurance, we refer to that as long tail risk. So we write casualty insurance, and I won't bore you too much with these details, I promise, but we write casualty insurance on occurrence-based forms, so you can have claims that come in 10, 15, 20 years after the occurrence of an event, right? Think long-term bodily injury type claims. So that's why we think and we believe that understanding risk on a really technical and granular level is important. When you're writing policies that you don't know if you're going to make money on it for 10 or 15 years, and it's an industry that we want to be deeply engaged with for a long time. We don't dip in and out of specific industries. We're a long-term stable player in the market. That's why industry specialization is important, and that's why we've kind of taken a new approach with this Climate Plus business, where we're looking at kind of novel and scaling technologies where we don't have the actuarial history and the loss history that we typically rely on. So I'll stop there. I will talk in more detail when we get into the Q&A. We launched also in the beginning of the year our methane emissions requirements for our upstream operator book. A global initiative. I'm focused on the North American piece, where we set out some multi-year requirements for our operators. And I'll get into that later.
Terrific. Matt, thank you very much. Niall Gerritsen is a portfolio manager at CalSTRS, and Niall, you have the floor.
Thank you. It's nice to be here. It's a real privilege to be on a panel here with such accomplished people, and also in front of a group like yourselves that's just so knowledgeable on this topic. Maybe I could tell you a little bit about CalSTRS and then our interest in methane from oil and gas operations. So we are the second biggest pension fund in the United States with about $300 billion under management. The biggest is CalPERS, public employees, also in Sacramento. We represent the state's public school teachers exclusively, and we manage money on behalf of about 1 million active and retired teachers. We have about $300 billion under management. That works out to about an average sort of account size, if you will, of about $300,000. So it's very meaningful for the people that we're investing on behalf of. We are diversified very widely across asset classes, and then within asset classes across companies. The biggest bucket we have by far is the public equities portfolio. We index that globally across about 9,000 publicly traded companies. And that accounts for about $100 billion of the $300 billion under management. And because of that diversification, which is so important because consistency of returns to us is more important than just the sheer size. Like to use a baseball analogy, we hit for average, not for power. As a result, we own probably 250 oil and gas stocks worldwide, and in every high-emitting sector: cement, steel, chemicals, electric utilities, you name it. Our retiree base, our beneficiary base, again, they're teachers, and one of the elements of what motivates them is giving something back to the greater good. So it's very much a values-oriented group. So while the state constitution of California requires us to prioritize or make our number one priority maintaining a financially sound retirement system, once we're achieving that, then seeing what we can do to use these assets in an effective way on a host of, I guess, less quantifiable priorities is very important to them. So the board that governs us set a net zero 2050 target for the portfolio, and they also set an interim target to reduce emissions 50% by 2030. It is such a fascinating challenge for me because I've been here a year and a half. Before that, I covered oil and gas on the buy side for 8 years. And it's exciting to kind of use what I know, and I recognize however much you think you know about oil and gas, there's like 10 times that you don't know. But to use that to drive progress against our emissions reduction targets. And when you kind of look across industries, look across the economy, and ask yourself, or at least this is what we've gone through, what are the most impactful things we could be asking companies of any kind to be doing on climate? It's really addressing methane emissions from oil and gas operations, and it's also a very, very happy coincidence that that's probably the most financially impactful thing that we can be asking them to do too, in terms of driving in a direction that's going to result in hopefully the companies making a lot more money and then making the stocks a lot more valuable. So I can talk, I guess, in greater detail about that during Q&A and why we believe that. But yeah, overall, methane emissions from oil and gas operations is really, top of the heap when it comes to things that we want to focus on with our net zero 2050 goal.
Thanks very much, Niall. Last, certainly not least, Tracy Cameron is Director, Corporate Climate Engagement, Oil and Gas at Ceres. Tracy, you are not a huge publicly traded company, I don't believe, nor the goddess of agriculture. So we will, well, perhaps, maybe you could give us a few words on the organization as well.
Yeah, thank you. And thanks to everyone at MDEL for including us. I'm just so happy to be here. This is a fantastic, full crowd for, post-COVID. But Ceres we're a nonprofit organization focused on building sustainable, robust markets. We were founded out of the wake of the Exxon Valdez oil spill by some investors that really wanted to use the power of their investments to influence what companies were doing. So our theory of change is focused around 3 different pillars. We have 3 different networks. We have a company network where we work with some of the largest U.S. companies to help them build that sustainable roadmap and help them, address the challenges they meet. We have a policy network which helps build the policy nest or framework that those companies need to be sustainable in the future. And then the group I work on is the investor network. So we have 220 plus institutional investors in our network with assets under management of about 60 trillion. And then we also partner with organizations similar to us in Asia, Europe, and Australia to really get a sense of what those investors are thinking about when they think about sustainable markets, the energy transition, and particularly oil and gas, which is the area I work in. So all of our investors have net zero commitments, and they are looking to figure out how energy fits into their portfolios for the long term. They are not interested in divesting. There are certainly investors that have divested, but the companies we work with really want to have those companies that they're invested in be part of the transition, be part of that slice of energy in 2050 that is providing both low carbon, low cost energy, but also returns for their shareholders and beneficiaries. So how I got here was through a convening we held a couple years ago, and I could talk about that, but it was a roundtable between investors and energy companies to figure out what the net zero transition looks like. And through those discussions, we started thinking at Ceres, well, really collaboration is so key to moving, making change. And geographies really are a good place to start. And can we look at the Permian Basin and see what can be done there? We look at things, we heard, electrification in the field is an issue. Water is an issue. We decided to look at emissions in the Permian Basin and how can that be addressed. And since we're a nonprofit focused on climate in Boston and we wanted to do work in Texas, we thought, well, that's not really a good idea without having someone on the ground in Texas who really can provide research and connections in Texas. So we connected with Melinda Taylor in the law school here, who has just been absolutely fantastic and connected us with Dr. Allen, Arvin, Aaron, and it's just been a fabulous collaboration.
Terrific. Okay, we have lots of fodder for discussion in the next 30 minutes. The main question coming through the system here is making fun of me for the Colorado is better quip. So I'm going to allow people in the audience to consider other questions as well. Now they're starting to come in. I'm going to just go through the panel with a few of my own, if you don't mind. So I think I'll start. We'll go back to Ben. And Ben, so you gave us an idea of why you care about it, of methane emissions, how it goes into your triple win or triple win, climate security and bottom line. Can you tell us a little more detail about the actions JP Morgan Chase is taking in terms of, well, investments, if you like, or other things that you're most happy with, and maybe some of the things you're not quite as happy with?
So where I want to start is several years ago, JP Morgan Chase pledged to align its financing with the goals of the Paris Climate Agreement. And then not so long after, in 2021, the firm introduced publicly the first set of 3 2030 carbon intensity targets for the financing portfolio of the firm across 3 sectors, oil and gas being one of them. And one of the differentiating aspects of the 2030 target approach for oil and gas for JPMC is that there are actually 2. One of them is for operational intensity reduction, and that was based on an understanding of the team and the organization at that time of the kinds of comments that folks on the panel have already made around the actionability, the feasibility, cost effectiveness, near-term nature of emission reductions. And so I like to say, if you double click on the 35% by 2030 target, which is a portfolio-wide, basically a weighted average target for JPMC, if you double click on the 35%, what you will find is the assumption or the framework is driven by progress on methane and flaring, to the tune of, again, on average, portfolio level, 75% reductions methane, 90% CO2 from flaring. So we are working toward that among our other targets, and since then, 3 additional ones, for what it's worth, have been released more on the demand side of the energy system. In terms of how we take action, of course, client engagement is a big part of it. JP Morgan banks large and small oil and natural gas companies in different markets and different parts of the value chain. The Center for Carbon Transition, CCT, as we call it, was established several years ago within our corporate and investment bank. And what they do is they provide financing advice, but also research and expertise, advisory to clients, including in oil and gas, on navigating the opportunities and the challenges of the low carbon transition. And so methane and flaring is one of the topics for engaging our clients and supporting them. And of course, since you asked sort of broadly about opportunities, and our senior leaders have commented on this earlier in the year, even on television, the growing industry of monitoring, measurement companies, those who are bringing to bear market-friendly solutions to industry, we're interested in supporting them in their growth journey too.
Thanks very much, Ben. So I'm doing sort of the softball questions, and then I'm going to switch, but I'm going to stay with those now. So Matt, how about a little bit more on your Climate Plus initiative and the methane requirements?
Yeah, absolutely. So as one of the larger insurance capacity providers in the oil and gas space, right? If you're in the action, or if you're in the camp where you want to take action, right? Where you want to make a difference, there's really two main directions you can go with it, and we've seen a lot of the one camp, right? Which is to basically remove capacity from the space, right? So to no longer write policies in the oil and gas space, and we don't really view that as effective. Those emissions are going to exist tomorrow if they find the capacity elsewhere, and it may disincentivize them from taking action. We find it more valuable, and that we can make more of a difference by setting out actionable criteria, right? So in March, I believe it was, we announced publicly our methane criteria and conservation criteria as well. We have, and it may seem pretty basic to some folks in this room, who are experts in the field. But we were really leading the market in terms of the insurance industry. So for our upstream operators, we set out a few basic criteria, which we'll work with them over the next couple years on. And one is, implementation of a robust LDAR program. Two is elimination of non-emergency venting. And three is showing improvements in terms of flaring efficiency. We did this through the lens of scientific research, right? We engaged our risk engineers very heavily, our technical experts. We partnered with EDF and used their guidance to kind of help us craft this framework. And further, we've created a methane resource hub for our clients, right? So it's kind of easy for us to just set out a bunch of criteria and this is what we want you to do by 2025 or we're not going to write your business. The harder work was establishing this framework, establishing this methane resource hub, which is going to, provide assistance to our clients as they kind of continue down their methane journey. It provides thought leadership. It's out there now, the website. We had a soft launch a few months ago. You can look it up. We have a hard launch with probably a press release in the next couple of weeks, which is going to go beyond kind of just the thought leadership on things like LDAR and elimination of non-emergency venting. It's going to provide them links to third-party measurement and data companies, right? Our risk engineering team has spent the last 6 months speaking with those companies. A few of them I've heard referenced in the room, and we're going to have those companies kind of linked into our portal as an additional resource for our clients. So that's what we're doing.
Yeah, I mean, both very impressive efforts from these big companies. Niall, you mentioned or alluded to a 2050 goal or target. Do you want to tell us a little bit more about that, a little more meat on those bones?
Sure. There may not be a whole lot to say. I mean, candidly, the targets we have are pretty middle of the fairway, aligned with IPCC guidance. I think admittedly, when you look at some of the industries that we're invested in, cement would be a prominent one. It's difficult with existing technology to see that pathway to, maybe 50% reduction by 2030 is possible at some plants. Net zero 2050, like truly on an organic basis, that's difficult. It's very difficult to see. But I guess pivoting it back to methane, though, one of the many things that we love about it is it's doable right now with existing technologies, acknowledging that the space is still evolving, but, it's very actionable, right? It's not aspirational.
Great. Thanks, Niall. So, Tracy, these three lads are all under severe constraints from their PR and corporate offices. You are a nonprofit and allowed to speak more freely, I'd imagine. So perhaps you could do so. Those of us who watch it a little bit see an awful lot of press releases about the trillions of dollars that are represented by certain agreements and principles, and that's been going on for, decades. What do you think is happening now? Do you see any big changes? Are you happy with the movement? Are you not so happy?
Oh, it's been a very tough haul. We didn't talking about this one. It's
you don't have to answer it.
No, it's an important question. It's an incredibly tough environment now for investors and for particularly nonprofits like Ceres. And I think we're mischaracterized by many often as, not supporting oil and gas, asking folks to get out of that when actually I think that is not the case. There are certainly people that feel that way, but we're looking to build collaborations between finance and the energy industry to figure out a path forward. We understand the problems energy security poses. And, we understand that the financial industry is looking for investments that they can, as Niall said, these are our pensioners. We're looking at generations that are beneficiaries of this, and we need them to have not only the financial health, but live in a world that's sustainable. So the political backlash is real, and it's a tough environment now. There's no question.
Yeah, thank you very much. So are any of Matt, Niall, or Ben? So this is largely a group of scientists and mathematicians and things like that, and I'm getting a lot of questions here, aside from being made fun of, about metrics and, do any of these goals change how your return hurdles or investment decisions? Can you tell us anything about that kind of detail for the companies you're looking at, or across a portfolio or in specific areas?
Yeah, I can take that. I mean, the main thing we're looking for is to see that companies, wherever they sit in the value chain, that they're raising their game on this issue. Now, with respect to hurdle rates and inputs into decision making, that's just candidly tough to do. But I could tell you the output that we're hoping to get from all this, to sort of tie where you are and what you see in the scientific realm with where we're coming in the financial realm, and probably where the C-suites are coming from with a lot of these companies is. We have an ocean of resource here in the lower 48 and also in Canada. And ever since late 2014, I mean, it just feels like forever. The oil-weighted producers, associated gas is a nuisance. It's not a super valuable byproduct. Concepts like flow assurance matter more than the cash flow impact, which is just bonkers. Especially now that we're in an environment where like JKM and TTF are trading in double digits. Henry Hub is still, the gas-weighted producers are still, eking out an existence, selling gas for 3-ish. You got stocks trading for below 3 times EBITDA. It's viewed collectively, the industry sort of, for other reasons, ran off a generation of investors, and many of them have not come back. So the ones who do, there's sort of this view that of the remaining investors that it's an industry in decline, and what at the same time though, it's like I'm always amazed when I go out in the field. I was just out in Midland yesterday. I mean, just the complexity and the scale of what the industry does and has achieved is just absolutely bonkers. And in terms of extracting hydrocarbons from tight rock, I mean, it's just and delivering it to the pump in a way that makes it look easy is just phenomenal. We're producing like 100 BCF a day of gas here, and the companies that are producing are not making a ton of money from it, let's be honest. And then you hear figures like the LNG market's going to grow by 100 BCF a day by 2030 from where we are now. And there's just an enormous prize up for grabs for whoever can really validate the methane emissions intensity of that gas. And like this industry in this country in particular can do it, and they should do it and provide just clear separation, proving that the American natural gas molecule and even the Canadian natural gas molecule is just highly differentiated and validated versus anywhere else in the world. So if you're a methane conscious buyer, you should never have questions in your mind about is fracked gas dirty or the Permian dirty, because the industry is capable of making it and validating that it is the cleanest molecule in the world. And here's the real rub where it gets super interesting is, valuations for upstream stocks is really a function of recycle ratios and drilling inventory depths. And, the companies right now are being valued, in terms of the gas, it's $3.5, maybe $4 forward strip when you get out a few years, and tier 1 economic inventory, 8, 10, maybe north of that if you're lucky, in terms of years of drilling inventory. But if we validate collectively the methane intensity of the American natural gas molecule, and establish greater and greater access to LNG markets. And so the producers here are suddenly getting, what they're netting back is, I don't know, call it 5 just for conversation's sake. Not only are you rolling higher commodity prices into future, valuation of future cash flows, suddenly all this like tier 2 and tier 3 drilling inventory that we have is in the money, and that becomes a part of the valuation calculus. Now you got people running valuations at $5 with 20, 25 years of inventory instead of, 8 years at $3. And the value uplift is just extraordinary from that. But, that's just upstream. You flow that through to then the visibility of the work that the oilfield service sector would have from that. Throughput volume, continuation, and even growth for the midstream. I mean, it gets just extraordinarily exciting. And so I think that's really the sort of the prize that's in our mind in terms of the business rationale for proving this out.
Terrific stuff. So I don't know about this audience, if you haven't worked in finance, that you can tell, one, these people know what they're talking about, and two, it's a totally different vocabulary to what you're used to. And so that's why this kind of panel is so important at a scientific event, because the pressure for methane or emissions reporting is, as you know, just as strong or stronger from the finance community than it is from other parts of the system. And so, great stuff. I don't know if we've heard today, and since I have a bunch of finance experts on the panel, was the Exxon deal mentioned yet in another panel? Not a lot. So, Pioneer deal, sorry. That's good. That's what their CEO would have said too. If we think about that as a new oil and gas V4 or something like that in the United States, where the investors have a lot, there's a lot of power there on and chasing revenues as opposed to maybe exploration and different things. Do any of you see? Any of you see that change impacting your business, or how you'll invest in oil and gas going forward, or the kind of pressure you'll put on your companies?
Maybe Tracy will probably chime in on this too, but Pioneer and Exxon were both, believe it or not, in my opinion, and I'd love to be corrected, pretty ambitious in terms of what they wanted to do, especially in the Permian, on achieving net zero, reducing the emissions intensity and the methane intensity of those operations. But it was interesting to me that the press release this morning very prominently mentioned some of these considerations. We're accelerating Pioneer's net zero ambition from 2050 up to 2035. But I think one of the things we're going to be really focused on is how, because there's going to be more of this, right? How do you bring together those goals and then measure progress against them in a transparent and accountable way? Because it maybe takes a little bit off topic, but particularly with methane, for example. Exxon was using MIQ certification for a lot of their production. Well, they expanded that to Pioneer. It is nice to see some positive things in there, but there's also unanswered questions, and we'll have to, I think, follow up and look for accountability.
Yeah, terrific. Tracy, you want to come in on that?
Well, we don't invest, we just support investors. I will say that the M&A we've seen, it always strikes me as there's an element of, the firms being acquired are also leaders in this space, starting with Concho a few years ago. The companies that are getting picked up are the companies that are really getting a handle on this. So I think, just in that, it demonstrates that that's where the market's headed.
That's a really important point. Ben, do you want to come in on any of this, as you like?
Actually, the point I wanted to elaborate on, and it gets to validation, which I think a couple panelists have mentioned, is just going a little bit deeper on data quality, which I think goes to the core and to the spirit of this conference. we have been public for 2.5 years now as JP Morgan Chase in recognizing the limitations and challenges with the quality of data around methane, and in sharing support for the shift toward direct measurement of emissions. To circle back to a question, Morgan, that I think you asked a few moments ago, the tool that we use to incorporate climate and carbon considerations in our capital allocation decisions is called the Carbon Assessment Framework, which our firm developed and applies across all of our Paris-aligned targets, including the oil and gas ones that I mentioned earlier. And so what the firm does is, when a potential transaction comes across our desk for a client or prospective client in an in-scope sector of the economy, we use this tool to look at where the company has been, is, and is going on carbon. We bring in qualitative and quantitative indicators, and we make an assessment from scale of 1 to 5 on where they're at, where we think they're headed. And that is considered as just one, but as one factor alongside things like revenue and credit considerations, risk, other things, as the firm makes capital allocation decisions. By the way, both for lending and also for so-called capital markets activity. So think about bonds and other ways of sourcing capital from the market. I just say that to say, how many of the experts in the room would invest your capital, your money, on historical emission factors and engineering calculations? So the point is just that over time, I think it is to the good as higher quality data, measurement-based, measurement-informed data is generated and supports constructive engagement, solutions-oriented engagement that the finance and investment sector can have with their clients and other business partners.
Thanks very much. I wanted to come to you, Matt. If you also help us, the insurance companies are usually the most sophisticated players on risk. So we talked a lot about capital, and risk is the other part of the graph. And just if you want to give us some more on some of those risk tools or how you think about the risks in this area.
Yeah, well, I'll comment briefly on the last topic and the quality of data and measurement of data. The way our criteria is set out right now, it's very much qualitative in nature, right? But we, and that's why we've partnered with some of the folks in this room and other third-party providers to provide the best tools that we can as an insurer, because we don't have those tools, right? But so that we can provide the best tools that we can to our clients so that the overall data capture improves. The way our risk engineers would evaluate the quality of an LDAR plan today, an overall kind of emissions view of a client, I think is going to be a lot different 5 years from now. So I'll say that. But in terms of risk, I mean, I'll talk a little bit about some of the, kind of the first party risks we face as an insurer, as a large property insurer in North America. When we look at some of the statistics, it's interesting. And I'm going to draw a blank on the organization that provided this data because I'm going off memory, but they track large weather-related kind of climate-influenced events, and they classify them, those large events, based on billion-dollar threshold, right? And from 1980 to 2022, kind of the average annual event, the average amount of annual events was 8, right? And this is indexed for inflation as well. And from the last 5 years, that's risen to 18. And in 2023, through the middle of September, it's $23 billion events. So, and it's not just your tropical cyclone, wildfires. The rise in non-modeled CAT events has been something that we watch very closely. 19 of those billion-dollar-plus events were severe convective storms. So, we have teams of catastrophe modelers, we have emerging hazard groups in all of our different product lines to kind of keep pace with this. Because that's going to cause an increase in insurance premium, and that's not really good for anyone. It can cause insurers to pull out of certain geographies. That's not good for anyone. So we're very much on top of that, and I'll go down the recruiting path too. I hear mathematicians and scientists in this room. We hire a lot of catastrophe modelers, a lot of actuaries. So if you're in the market, come see me at the cocktail hour.
There you go. You're welcome to the young people. Two things. Niall, I was wondering, you have any view on the role of, we haven't talked about private equity. Tracy, I don't know if either of you, I just wanted to, it's another part of the market. We don't have someone represented clearly, and it happens to be a pretty important one for oil and gas. I don't know if you had any views on any of that.
We do a little bit of work with private equity. There are some very thoughtful private equity firms that have this as a priority. So one I'm thinking of, when their companies, when they bring a company into their portfolio, they require that they go out and join some of these organizations. And we are seeing that more and more. So, I think there's been a lot of movement in that space in the last 3 years.
Okay. A good news story for private equity. You heard it here first. Two questions to finish, and I don't know who might be willing to do this, but if the political winds changed dramatically, like they have in the United States in the past decade, and say someone took us out of the Paris Agreement, theoretically that could happen, or other things that change the political winds, how does that affect these sort of initiatives and company goals that you each have, or what you're seeing from investors? Anyone willing to give that a shot?
I'll take that.
Okay.
But my answer might be different than Matt and Ben.
Yeah,
but we're not going to change it all.
Okay.
And the reason for that is kind of twofold. One is that frankly, our clients can't leave us. The teachers, they're right. It's a very different dynamic than if we were BlackRock or State Street or anybody in the active management side, Wellington Capital Group. I mean, I'm not trying to single anybody out, but just the nature of their businesses, clients can leave if they don't like what you're doing. In our situation, that's not the case. So we effectively have permanent capital, so we can forge ahead as long as the teachers support us in what we're doing, and our board likes what we're doing. The other dynamic is just simply being in California. It kind of gives us good air cover. So I always feel like I have support up the org chart to the board, and then even you could probably extend that to the governor in terms of looking at legislation he's been signing. But the overall though, the business imperative for addressing methane emissions from oil and gas operations is not going to change based on the politics. Like the business case is still there, and so that's why we're gonna keep pushing on it. We're gonna keep pushing on anything that has that sort of multiple benefits to it that Ben alluded to, being good on climate and being good for business.
That's terrific. It's a great quote for MDL going forward, too, I would note. I'm going to end. We have a few minutes, but I'm going to give you a couple minutes back. So how about developing economies? So it's risky to invest in a lot of developing economies, especially least developed economies. And some of the new finds on the oil side, certainly we've heard of, Guyana, of course, but also Namibia recently. And, as you think of this global landscape, and anyone could come in, Ben, the way you could come in is just by putting up your hand. But how how are you thinking about those risks and opportunities in developing economies, or are you?
Maybe the connection there is through non-operated production of the majors. I don't have a great answer for that yet, because they always say, oh, we can't control our operators. But it's something we'll need to have an answer for. I don't know if you have any.
Tracy, are you seeing any appetite for that from?
You know, I don't work closely enough to weigh in on that. But going back to what you asked, Niall, I think, you know, it is a business risk. I think that we look at climate risk as a financial risk. And if the U.S. pulls back on being able to deliver what the global markets want, so that's really quite short-sighted. So it's a market risk. Our investors are not doing this for a moral cause. They think that it's really the wave of the future. So that's why they want to, you know, understand who's going to be in that leading pack in 10 years.
That's an incredibly important point, of course, that is too subtle sometimes to say, but you know, the drivers of the overall risk are much more powerful than the moral piece, at least to keep things stable for long times. Yeah, please, Matt.
Yeah, and I won't comment too much on this. I mean, I lead our North American initiative, but we certainly write large multinational US-based corporations and provide multinational insurance coverages for them. So it is top of mind. I will say the criteria, right, because we're not an investment vehicle or an investment fund, the criteria we've set out has very much so far been focused on operated emissions. The criteria for us is going to be iterative over time, right? As we've set out our initial set of criteria. We just started at July 1st. We're kind of in our infancy with it, but we're learning each day as we gather more information, gather more data. It'll be iterative to the point where we will at some point be looking at non-operated assets, whether that's in the developing economies. We're not quite there yet, but more to come over time.
Okay, thanks a lot. Yeah, and Ben, I'm going to turn to you. How about your last 30 seconds to a minute?
Okay, I like the time clock. So 2 or 3 thoughts on this international emerging markets point. One, I know we're all watching COP28, and I think that methane and flaring reductions are one of the potential priorities or topics that have come into focus in some of the dialogues and stakeholder engagements in the run-up to COP28. 2, I would encourage colleagues to look at a piece put out just a few weeks ago during Climate Week, in fact, by my colleague Fuat Sabas, who co-heads up our infrastructure finance and advisory practice, really focused on what's needed to accelerate capital mobilization, in other words, putting money to work in emerging markets and developing countries. He talks about work of groups like the Global Infrastructure Facility at the World Bank and how there's a gap in really preparing projects to the point of bankability, which is needed across a set of technologies and emission abatement options. And then, Morgan, as I tick toward the 60-second mark, the thing I would land on, coming back to the business opportunities and just the business side of this is, I'm thinking about some discussions with methane tech innovators and entrepreneurs who have some really promising solutions, but may not yet have the resources and the full capabilities to go international. And those are the kinds of growth journeys that we want to identify and support our clients on as they grow to serve international markets.
Terrific. Tracy, final parting.
Dr. Allen said something today that just, resonates with me constantly, that he started looking at methane emissions 10 years ago. 10 years. And look at, Chubb has built this tool. I think we don't often look back and see how far we've come. We've got a really long way to go. But, to think in 10 years, we're here talking about methane, and methane is embedded in, bond covenants and executive compensation and business strategy is pretty remarkable.
Terrific. Any last thoughts?
just that it's really awesome to come here and see how many people are like, just going so deep on this.
Yes.
It's really, really cool, and it's not just academic. I mean, I truly believe like the stuff you guys are doing is good for climate, and it's making the companies better and more valuable. No doubt about it.
Thank you.
Sure. You know, one thing that's been on my mind is that sorry, like yelling into this mic, sorry. One thing I've noticed in working in insurance and oil and gas for you know, the last decade, there's definitely been a mindset shift as I'm out meeting with clients, which is impressive and kind of gives me hope, right? I was out in Midland a couple months ago and was on site getting a tour of one of their well sites, and you know, this wasn't the CEO talking, it wasn't the CFO, it was one of their you know, health and safety managers, you know, and she you know, not unsolicited, kind of shared with me that, you know, she basically said, look, we understand that we need to act for the viability of our industry, right? You know, these jobs are important to us. So you know, just that little conversation stuck with me, that 5 years ago that wasn't really talked about, right? But just a couple months ago, you know, unsolicited, she probably didn't even really know why I was there, just that she was given another tour. You know, I thought that was pretty cool.
So, ladies and gentlemen, an extraordinary group of people, clearly well-versed in the topic and a very different take than we've had previously today. Can we thank them in the typical manner, please? Thank you.